Okay, yes. So an interesting title, perhaps, from a UK equity fund manager. But let's get to it. So I'm going to talk about, as we've said, why you should not just buy the UK equity market. And we're going to cover, is the UK an attractive economy? Does it matter how cheap it is? I'm sure we've all heard how attractively valued the UK is. I could have started that, but that would be an obvious place to start. If that is the case, or that doesn't matter, what should investors buy? And at the end, we have some stock examples which may give a clue as to the underlying message that I'm trying to give to you today. So, reasons why you should not buy the UK. Well, there are plenty of them. I need one slide. I probably could have done a couple of slides if I wanted to, but you can keep choosing them. Economic slowdown, pretty much ever since Brexit, the UK economy has been fairly slow. On top of that, we've had COVID. Initially, obviously, people weren't working. Then we had a flood of liquidity into the market. Then we had issues coming out of COVID in terms of supply chain. That caused inflation. Then we had the Ukraine conflict, issues with energy prices. Just on top of each other, all these issues kept coming. As I said, post-COVID, we had pretty high inflation. They all told us it'd be transitory. It wasn't very transitory, and it's actually been quite sticky, albeit down from that high in October. Big rise in inflation meant a rapid rise in interest rates. Again, coming down now, but from a very high level. The UK has ongoing issues in terms of budget deficits. We have to borrow more and more every year. Admittedly, we're not alone. We have that problem. The issues of the Truss Kwarteng budget in 2022. Rates shot up, came down fairly quickly because the Bank of England helped. But I still think there's a hangover from that. Every time interest rates go up in the UK, we get commentary a bit like it was then, happened in January this year. So there's still negative sentiment from that around as well. Generally low confidence in UK government policy. I think no one has a great deal of confidence. I've not found anyone who thinks the government really know what they're doing, that they're really on the right track. That doesn't help equity markets either. One of the things that gets talked about quite a lot is we don't have great growth companies in the UK. We don't have a lot of technology exposure. Therefore, the market doesn't grow, therefore we shouldn't be valued more. I think there's an element of truth in that. One of the greatest technology success stories to come out of the UK, Arm Holdings, when it relisted into the US. And the UK pension funds for many, many years have been selling UK equities and investing in the global markets. So I think the US is about 73% of global equities at the moment. UK pension funds are probably around about 4%. It's very difficult, actually, for equities to go up if someone's selling them all the time. So there's a pretty difficult backdrop. All of those things have impacted on valuations. So the summary, obviously, is it's not an attractive place to invest. The economy is slow. The budget, which I'm not really talked about, but it had a lot of press in October, was not what investors hoped for, particularly after a positive run-up to it. We were all very disappointed. I don't think just investors. I think individuals, I think businesses, it managed to disappoint pretty much everyone, I think. And that, again, that hangover's carried on. And investors seem to have voted with their feet. Any chart that looks at fund flows into UK equities, the last pretty much any period you want, makes some pretty dismal reading. So the backdrop's not great. But, and I think there is a but, actually unemployment remains robust, wage growth continues. Lead indicators of inflation are improving, albeit very slowly. Because of that, interest rates have started to fall, albeit not as much as we would have liked. Probably means UK mortgage interest rates have peaked. And I mentioned this a little while ago. If you think about valuation, any metric the UK is cheap. So there are some positives we should think about. Touched on a couple of those. The chart on the left looks at employment and unemployment. In terms of employment, more people have never been employed in the UK. Now, population's higher, but we've never had more people in work. At the same time, while unemployment's picked up a bit, we're pretty close to a 50-year low. Now, national insurance contributions will start to bite from next week, albeit businesses have had some time to prepare, so maybe unemployment gets a bit worse from here. Leisure and hospitality, retail, those are sectors where managements have been very clear that it will impact them. But we're starting at a pretty good base. Right-hand side looks at consumer confidence and business confidence. Been a bit weaker of late, but not that bad. We're not feeling that bad about the world, about our domestic economy, despite or the negatives. In terms of the consumer, the ASDA income tracker looks at the disposable income of average UK individual. And we've seen 9 months in a row now of double-digit increase in disposable income. Wages are rising, and obviously that's a bit of an issue for inflation, but people are seeing more money come in the wage packets. Interest rates have come down a bit. This is a measure for post-mortgage payments. So individuals have more money in their pocket, they're in work, and actually there still seems to be plenty of vacancies at the moment. And lastly, the savings rate we saw this week is at 12%, very high level. So the UK consumer is in a pretty good place. They perhaps don't have the confidence to really spend at the moment. So there are reasons to be cheerful. It's maybe not all doom and gloom, and there's more to come. So all of us are not the only people who recognise that the UK looks attractively valued. Other buyers of businesses do as well. So you think about M&A, in the UK last year, there were over 40 bids for UK companies. The perception, I think, is that this is usually private equity. They've raised loads of money, they use lots of debt, they buy businesses really cheap. There is some of that. Hargreaves Lansdown has been bought by CVC. But we've also seen international buyers buying UK companies. International Paper, US paper company bought DS Smith. And we've seen domestic businesses take advantage of very low valuations to help their own business to take some synergies of Aviva buying Direct Line. So there's lots of activity going on. I cannot tell you what the next UK business to be bid for or bought will be. I'm very confident there will be more to come in 2025 if we do not see a big recovery in UK valuations. So some positives there. In terms of returns to shareholders, I run a trust called UK High Income. Therefore, dividends are very important to me in order that we can deliver returns to our shareholders. And the UK remains one of the highest paying dividend markets in the world. The US, very different, tends to be much more about share buybacks. That's how they return money to investors. But those dividends are also growing. So not only are their returns coming back to shareholders, they're growing as well. I think even more importantly what we've seen recently is a pickup in share buybacks, particularly from UK companies. Again, I mentioned earlier, it's difficult for shares to go up if everyone's selling them. Well, if someone's buying them, even yourself, that's not unhelpful. And many, many more UK companies are recognising that valuations are so low, one of their best uses of free cash flow is to buy back their own shares. I'll use the example of Legal & General. Legal & General is a stock we've owned for many years. It pays around about 8% dividend yield at the moment. It's come down a bit because the shares have gone up. They increased that dividend yield in this year's set of results, but they also announced a share buyback. And that share buyback will increase as they finish some corporate transactions. So buying their own shares yielding over 8% is a pretty good way of returning value to shareholders. And in fact, over 40% of the companies in the FTSE 350 are buying back at least 1% of their shares this year. So there's more and more people who are saying, actually, yeah, we think the UK is great value. So that's pretty good as well. Talked a little bit about rate cuts. It's very important to all of us in the UK. Housing wealth is a big part of UK consumers' wealth. It's a big part of how we feel about the world. If house prices are going up, we tend to feel good. If they're going down, everyone's a bit miserable. Therefore, interest rates are very important. UK rates, as I said, have not come down as much as we would have liked at this stage. Inflation is a bit more sticky, but they have come down. We expect them to come down further. And the UK is one of the strongest correlated markets to rate cuts. Basically, as rates come down, UK equities, as a rule, do better. Another positive to think about. And then I talked about valuation earlier. I could have picked pretty much any valuation metric that I wanted, and the UK would have looked attractively valued. The one I've picked here is sector adjusted. One of the arguments as to why UK valuations are so low is, well, as I said earlier, there's no growth. There's no technology companies, therefore they should be cheaper. This adjusts for those sector imbalances, and on that basis, and this is a 30-year chart, the UK is almost as cheap as it's ever been. Actually, we've seen a small recovery of late, which I think is indicative, perhaps, of some changes we're seeing, whether it's driven by the extreme valuation in the US, whether it's driven by the antics of President Trump, I don't know. But certainly there's more interest in UK and I should say European stocks that we've seen for some time. So the conclusion to all that, which sort of goes against perhaps what I said, is that there are some reasons for optimism. The backdrop's been difficult for a long period of time. The market's cheap on any measure relative to its own history, relative to other markets, relative to other assets. The dividend yield on the FTSE on the UK is about 4%. That's a 4%-ish real yield, pretty attractive relative to, I think, to bonds. M&A is picking up. That's good when you own companies because you get a big premium, but it's also indicative that other people, other investors, other participants think the UK is a better place to invest than we thought. Dividend buybacks combined are higher than any other market. Now, I think EPS growth will be lower in the UK than perhaps the US, but returns to shareholders are high and show that companies understand they need to deliver returns to their investors. We may not like everything or perhaps anything that this government has done in their relatively short time in power, but we do have stability. They are here for a long time, whether we like it or not. Actually, behind the scenes, I think there's a lot of deregulation going on. This takes longer. Supply-side reforms take longer to work. So whether it's changing planning laws, whether it's some deregulation. The FCA, I think, has been seen by many of its regulated companies, banks, insurers, asset managers, as fairly adversarial for the last few years, as more against the industry than with them. They now have a growth mandate given to them by a Chancellor. The head of the FCA has recently put forward his own effective pitch for another 5 years to how he can help drive growth. So there's definitive change, and I think that's something we need to think about as well. The economy has got a bit better on the back of interest rates. As rates come down, we think that continues. Evidence of history shows us that is what happens. And I said real income growth is actually pretty good. Savings rate is very high. The backdrop for consumers is positive. It is fair to say the level of confidence they have to go out and spend on new houses or holidays or whatever it may be is perhaps not where it could be at this point in time. And I mentioned then the housing market. This will be and will always be stimulated by lower rates. I think we built less houses in the UK last year than we did in 2009, the year after the global financial crisis. That shows some of the problems with planning. It shows some of the problems with giving the house builders a bit of a kick to get them going. And the government is working hard on those things. They don't get any credit for it now. If it works, perhaps they should. Right, so I've started off by saying why you shouldn't buy the UK market, and now I've given you a load of positives, so the answer is clear, you should buy the UK market. Well, actually, no. You still should not just buy the UK market. Why not? Well, what are you actually buying? FTSE 100, as its name says, there's 100 companies. The all-share, I think, is 554 companies. That's dominated by the FTSE and the larger companies in the FTSE. Those large companies are not large because they're NVIDIA that is growing tens of percent year on year, month on month, and making record high margins, generate huge amounts of cash. Most of those companies are large because they used to be quite good a long time ago and got very big, or because they've made loads of acquisitions, often at crazy prices. And if anyone remembers Vodafone buying management in 2000, never got anywhere near the share price they had there ever again. They destroyed huge amounts of value. Glaxo. Glaxo is a combination of Glaxo, Wellcome Trust, SmithKline, Beecham, I'm sure there are others. Lots of acquisitions that have made it big. Not a bad business, but not growing particularly. So you get lots of things you're not really sure about. Only 25.6% of the all-share revenues come from the UK. So you're not even buying the UK. And that's almost exactly the same as the share of revenues that comes from the US. So you get a quarter UK, quarter US, and 50% of the rest of the world. So what are you actually buying? And then the valuation. Yes, the UK is attractively valued. Absolutely accept that, and I've demonstrated that as well. But obviously the UK valuation is an average measure of 554 different companies, which I don't think everyone wants to own all of them, probably doesn't want to own most of them. So if you just buy the market, whether that's hugely diversified funds, whether that's ETFs, whether that's some sort of tracker, you get to buy all that. So actually, no, you should not buy the UK equity market just because it's cheap, just because maybe you're showing a bit more interest in it. Frankly, nor should you just buy, in our opinion, any market or any region. You need to be discerning, because when you buy the market, what happens is you dilute any of the positives and you add a number of factors which maybe you don't want to have. You don't want to have exposure to, and probably you neither understand them either. So, UK is looking better, but I still wouldn't buy it. So what should you do? Very quickly, okay, I manage the CT UK High Income Trust. What is that? It's UK focused. 33% of our revenues come from the UK, only 20% from the US. It has the ability to invest outside the UK for 10%, to get exposure to great companies that we cannot get elsewhere. So technology, we're an SAP, German listed, one of the world's biggest software companies, huge beneficiary, we believe, of AI. We provide a high level of income now, 5.9% as a dividend yield. We believe we can grow that dividend yield into the future by investing in really good companies. And in fact, the board announced this week that the dividend for this year has been increased by 3%. We can use gearing as an investment trust. That helps to drive higher returns for our shareholders. And at CT High Income, we have a pretty unique share structure. We have ordinary shares and B shares. The ordinary shares pay all the dividend out of income. The B shares paid out of capital. So it's a capital return that may be advantageous for some investors. The manager changed to me in July 2023. It's a relatively short time period, but we've worked very hard to turn performance around. I think we've done a pretty good job in that time period. So in those 2 years, and when I took over in July, the fund was behind the benchmark, so performance looks actually better, or slightly better than it looks. So we've delivered, I believe, good total returns, and we've paid a high level of income that has grown the way through. So to me, this is an example of what you should buy. It's relatively concentrated. We focus on buying good companies with good levels of income that can grow into the future. So you as investors know exactly what you own, not a little bit of 554 different companies. And perhaps I'll pause there for any questions.